Well, this morning we're launching a new series here on the third hour of today. It's called Know Your Words.
My mom used to tell me that when I was little. Use words.
Know your words. So we're going to help you take control of your money by breaking down some personal finance terms that are frequently used but often misunderstood. And here to do that, NBC News business and data reporter Brian Cheung. We like this. Know your words.
Yeah, and I brought, by the way, the tweed, the professor look.
I was
trying to go for. Yeah, that was the idea.
Looks Professor Cheung.
So let's start with inflation and recession, because we use those words a lot. I don't know if everyone knows what they mean, but how are they related? How are they connected?
Yeah, well, for the last year and a half, we've been hearing inflation, inflation, inflation. Well, inflation is a noun, and it refers to the rate at which prices change. So usually going upwards, right? If it was the opposite direction, it'd be called deflation. And a lot of people have been experiencing this at the store, right? The pace of price increases has been so dramatic at the grocery store, at everywhere else.
Constantly.
Exactly. But it doesn't necessarily mean that it's going to lead us into a recession. A recession is defined as a period of economic downturn, which could be, it has been in some cases, triggered by inflation, but it could also be the result of a number of other things. You think about the financial crisis, right? That wasn't inflation in of itself. It was a few banks blowing up. So there's just there's many different ways that a recession could happen, but broadly speaking, it just refers to a time when economic activity in the country slows down.
How many consecutive quarters for a recession? 2.
But it's important to note the National Bureau of Economic Research is the one that determines whether or not we're in a recession. They haven't said we're in one right now, but they're the kind of ultimate authority on deciding that.
All right, Professor. Chapter number 2,
Yep.
We're going to deal with assets and debts.
Yeah, so these are also big buzzy words, too. And, if you have a personal finance advisor, these are things you've probably talked about as well. Assets are anything that you own of economic value. So think about your home, your car, other things like that. It could be things you have in your house, your couch, your jewelry. Debt, though, on the other hand, is anything that you owe. So if you have a personal loan, a mortgage, a car loan, those are things that obviously you owe to the bank or you owe to somebody else. So when we talk about net worth, how much are you worth? How much is your household worth? It's basically taking your debt and subtracting it from your assets. So that's what those mean.
It's like calories in, calories out.
Exactly, exactly. Perfect way of thinking about it.
Okay, so we know that now. Let's talk about interest. And interest can kind of go in your favor or not.
Yeah, well, I mean, that's relevant for debt, right? So when we
Right.
talk about interest, we often think about, okay, well, how much do you owe when you take a mortgage out? Right now, rates are 7%. But we also have to remember interest works in your favor as well. If you're putting money into the bank, you collect interest. But what's really important to remember about interest is that it compounds, right? You have more money in the bank, you're collecting interest, and then interest compounds on that. But it
Okay.
works the same way with debt as well. So if you're borrowing money on a credit card, for example, well, that debt accumulates. If you don't make your payments, you get interest deducted or you have interest added to that. And that adds up over time. So something really important to remember.
You got some great interest rates right now in some savings accounts out
Yes,
there, too.
but not on your loans because mortgage rates are like that.
Yeah.
Really quickly, before you go, stocks and bonds. I think most people know what a stock is and they know what an equity is, but the difference between stocks and bonds.
Yeah, well, as a reminder, I mean, stocks are things that you can have a portfolio with. You can trade on a certain company. I like this company. I want to buy the stock. So again, it's shares of a company and you can have a stake in that company. You get dividends in some cases by investing in it through a brokerage, for example, which you can do even on your phone these days. Bonds are another way that you can invest as well. Some people, you might be aware of U.S. bonds you can buy in the government. You can also get bonds from a company as well. That is structured a little bit differently. Basically, you'll give a loan to the company, or when you buy a U.S. bond, you're basically giving a loan to the government, and then they'll give you interest back that collects over a certain duration of time. So a bond would be, let's say, a year or 2 years or 5 years, and then over the duration of that bond, you end up getting some coupon payments, which is nice. Exactly.
Great segment,
Thank you,
Brian.
Professor
Brian
Cheung.
Cheung. We
This was
like
great.
that.
Yes,
Know
thank you
your
so much.
words.
Hey, thanks for watching. Don't miss the Today Show every weekday at 11 a.m. Eastern, 8 Pacific on our streaming channel, Today All Day. To watch, head to today.com/allday or click the link right here.